Picture this. It's August 1998 in Moscow. You're a secondary school teacher. Your monthly salary has just been deposited, 2,000 rubles. You don't think about sovereign bond markets. You think about groceries, rent, and maybe converting part of your pay into US dollars before prices move again. The morning exchange rate is roughly 6 rubles to the dollar. Not great, but manageable. You step into a currency kiosk with a simple plan. Exchange 1,000 rubles, keep the rest for bills. By noon, the rate isn't 6 anymore. It's closer to 6.8. The line behind you is longer now. The clerk isn't making eye contact. She says the system is updating. You check another booth down the street. Different rate, wider spread. Someone whispers that government bond yields jumped again this morning. You don't own government bonds, but suddenly they seem to own you. By mid-afternoon, the booth stops selling dollars entirely. You walk to your bank branch. The ATM still works, but it limits withdrawals. People are speaking in low, tight voices. A man in front of you tries to withdraw more than the daily cap. Denied. You hear the phrase GKO restructuring for the first time. It sounds technical, distant, harmless. It isn't. By evening, the news confirms it. The Russian government has effectively defaulted on its short-term debt obligations. The ruble will no longer be defended the way it was yesterday morning. Tomorrow, the exchange rate may not resemble anything you saw today. You didn't lose your job. You didn't overspend. You didn't speculate. But the value of your salary is already dissolving. Same paycheck. Different reality. This isn't fiction. What happened to you in that Moscow exchange line wasn't chaos. It wasn't political theater. And it wasn't a mysterious market panic. It was sequence, a mechanical sequence that has repeated across countries, currencies, and decades. In the next few minutes, we're going to break down the 4 structural steps that allow a government to default, without ever technically running out of money. 4 steps, no drama, just arithmetic. Step 1, short-term debt addiction. Step 2, the yield spiral. Step 3, reserve drain. Step 4, currency as shock absorber. Each step builds pressure. Each step compresses time. Each step narrows options. By the time the word default appears in headlines, the structure has already failed. The announcement is the echo, not the explosion. And here's the uncomfortable part. None of these steps require incompetence. They don't require corruption. They don't even require recession. They only require one thing. Refinancing that stops working. Miss one cycle, confidence fractures. Miss 2, the system tilts. Let's start at the beginning. Not with collapse, but with something that feels rational. Step 1. To understand Russia in 1998, don't picture a parliament chamber. Picture a credit card. Not one you can pay off over years. One that resets every 30 days. Full balance due. No installment plan. Now imagine your income doesn't cover your expenses, so every month you open a new credit card to pay off the old one. It works, as long as the new card gets approved. That was Russia's short-term debt structure. In the mid-1990s, the Russian government financed itself heavily through short-term treasury bills known as GKOs. These weren't 10-year bonds. They weren't 30-year commitments. Many matured in 3 months, some even shorter. That means every few weeks, the government had to refinance itself, not eventually, continuously. Rollover is oxygen. Here's the arithmetic. Suppose the government issues 100 billion rubles in short-term bills at 20% annualized yield. Investors buy them. The government pays salaries, pensions, operating costs. 3 months later, those bills mature. The state now owes the principal back, plus interest accrued. If tax revenue is insufficient, there's only one solution. Issue new bills to pay the old ones. That's not fraud. It's common sovereign practice. Until yields rise. Now imagine investors demand 40%, then 60%. By 1998, some GKO yields were spiking toward 80% or higher. Not because investors were greedy, but because they sensed rising risk. Higher yield means higher refinancing cost. Higher refinancing cost means larger future issuance. Larger issuance increases supply. Increased supply pushes yields higher again. Debt feeds itself. The system doesn't collapse because the government runs out of money. It collapses because the time between funding needs becomes shorter than the time confidence can stabilize. Miss one auction. System stalls. And here's why short-term debt is seductive. It looks cheaper at first. Investors accept lower yields when maturities are short. Governments prefer it because long-term bonds lock in high rates for years. Short-term paper feels flexible, adjustable, manageable. It's the financial equivalent of paying only the minimum due. It works until rates adjust upward faster than revenue grows. In 1998, Russia's fiscal position was already strained by low oil prices and weak tax collection. That meant real cash inflow was limited. Yet short-term maturities kept coming due. Weekly, monthly. Each auction wasn't just routine funding, it was a referendum. Will investors show up? Will they demand more yield? Will they roll over? Every successful auction postponed stress. Every failed one compressed it. This is the addiction part. Not emotional addiction. Structural addiction. When your debt matures in 90 days, you don't have a debt problem. You have a clock problem. Short maturity compresses time. Time compresses options. Options shrink fast. And here's the critical insight. At this stage, nothing has defaulted. The government is still paying. The currency still trades. Shops still open. On the surface, stability. Underneath, rollover dependency. Same pattern, different country, no drama, just arithmetic. Step 2. The yield spiral. Short-term debt becomes dangerous the moment investors hesitate. Not panic, hesitate. Imagine you're lending money to a friend every month. At first you charge nothing, then 5%, then 10%. Not because you want more profit, but because you're less certain you'll be repaid. The higher rate isn't greed. It's compensation for doubt. That's how sovereign yields move. In early 1998, Russia's short-term bonds already carried elevated rates. But as oil prices weakened and fiscal deficits widened, investors began demanding more yield to roll over GKOs. What had been expensive became extreme. Annualized yields surged toward 60%, then 80%. Higher yield sounds like investor confidence. After all, people are still buying. It isn't. It's stress pricing. Here's the arithmetic. If the government owes 100 billion rubles and refinances at 20%, interest costs are manageable. If refinancing jumps to 60%, interest expense triples. That additional cost must be financed, usually by issuing more debt. More issuance increases supply. Increased supply pressures prices. Lower prices mean higher yields. Higher yields increase interest cost again. Yield drives issuance. Issuance drives yield. The spiral begins. Now consider growth. If an economy grows at 2% but debt costs 60%, there is no path to stabilization without dramatic fiscal adjustment. The math diverges, not emotionally. Mathematically, when the cost of capital exceeds the growth of income, the gap compounds. Debt accelerates faster than the economy that supports it. That's when refinancing stops being routine and becomes existential. Investors don't need to coordinate. They don't need conspiracy. Each participant acts rationally. Each asks, will the next buyer demand even higher yield? If the answer is yes, holding today's bonds becomes unattractive. Liquidity thins. Auctions wobble. Spreads widen. Confidence erodes quietly before it collapses publicly. Here's the key. The government is still paying. No formal default. No missed check. No dramatic announcement. But the cost of survival is rising every week. Debt markets don't shout first. They reprice first. And repricing is mechanical. In Russia's case, domestic banks were large holders of government debt. That means when bond prices fell, bank balance sheets weakened. Weaker banks reduced lending. Reduced lending slowed economic activity. Slower activity reduced tax revenue. Lower revenue increased deficit pressure. Deficit pressure required more borrowing. The loop tightened. This is why yield spikes matter more than headlines. They signal that time is compressing. When refinancing cost rises faster than revenue capacity, the window narrows. Not theory. Arithmetic. And here's the subtle shift. At this stage, the problem is no longer just debt. It becomes currency credibility. Because if refinancing becomes too expensive in domestic terms, the pressure migrates somewhere else, toward reserves, toward the exchange rate. The spiral doesn't end with yields. It moves. Always. Step 3. Reserve drain. When bond markets become unstable, pressure doesn't disappear. It migrates. Up to this point, the problem has been refinancing cost, yields rising, auctions tightening. But once investors begin doubting rollover capacity, they stop worrying only about bond returns. They start worrying about currency value. Because if debt becomes harder to refinance domestically, devaluation becomes the silent alternative. In 1998, Russia was operating under a managed exchange rate band. The ruble wasn't freely floating. It was defended within a range. That defense required one thing: foreign currency reserves. Think of reserves like a water tank on the roof of a building. As long as the tank is full, pressure flows through the pipes. When pressure drops, you open the valve and release more water. But the tank is finite. Reserves are finite. When investors began selling rubles and demanding dollars, the central bank intervened. It sold U.S. dollar reserves to buy rubles, attempting to stabilize the exchange rate. On paper, this signals strength. In reality, it signals defense. Defense consumes ammunition. Now layer the arithmetic. If short-term debt yields are 60 to 80%, investors are already uneasy. If they also suspect the currency might weaken, they demand even higher yields to compensate for currency risk. Higher yields intensify the refinancing spiral. That spiral increases perceived risk of devaluation, which increases capital outflow, which forces more reserve spending, which reduces reserve coverage relative to short-term obligations. This is not panic, it is incentive alignment. If you hold ruble assets and suspect devaluation, converting to dollars becomes rational. If you are a foreign investor, exiting early reduces exposure. If you are a domestic bank, hedging becomes survival. Each action is logical. Collectively, they drain reserves. In early 1998, Russia's reserves began declining as pressure mounted. Meanwhile, short-term debt maturities remained relentless. The central bank was defending two fronts simultaneously: the bond market indirectly and the currency directly. One balance sheet, two fires. Here's where compression becomes visible. If reserves fall below short-term external obligations, markets calculate coverage ratios. If coverage looks thin, exit pressure intensifies. The lower reserves go, the more incentive investors have to leave before others do. The exit accelerates not because people are emotional, because they are early, and once reserves decline fast enough, defending the peg becomes mathematically unsustainable. Not politically difficult, not diplomatically sensitive, unsustainable. The water tank empties. When reserves fall, credibility follows, and when credibility weakens, yields no longer reflect compensation for risk. They reflect anticipation of regime change. At this stage, the government still hasn't run out of money. It is still operating. Salaries are still paid. Bonds are still technically active. But the buffer is shrinking. Time compresses again. Because once reserves can't cover both currency defense and short-term rollover needs, something has to give. And historically, it's rarely the bond market that absorbs the first blow. It's the currency. Always. Step 4. Currency as shock absorber. When refinancing strains and reserves thin out, policymakers face a narrowing set of options. They can raise rates further, which worsens the debt spiral. They can impose capital controls, which freezes liquidity, or they can allow the currency to adjust. In 1998, Russia chose adjustment. Think of the currency as the pressure valve in a sealed container. If debt cannot be reduced immediately and reserves cannot be replenished fast enough, the exchange rate absorbs the imbalance. Instead of defaulting in nominal terms, the system resets in real terms. The ruble weakened sharply. Now, here's the arithmetic most people miss. If your government owes debt denominated in domestic currency, it technically has the power to print more of it. That means it doesn't need to run out of rubles. But when the currency weakens, the purchasing power of those rubles falls. Imported goods become more expensive. Inflation rises. Real wages decline. The debt burden doesn't disappear. It shifts. From the state's balance sheet to the citizen's wallet. The currency pays. Suppose you earned 2,000 rubles in August and the exchange rate was 6 per dollar. Your salary equaled roughly $333 in purchasing power. If the ruble weakens to 12 per dollar, your nominal pay is unchanged. But your external purchasing power is cut in half. No missed paycheck. Different reality. For the government, devaluation reduces the real value of domestic liabilities. For exporters, competitiveness improves. For holders of cash savings, the effect is immediate erosion. This is why sovereign defaults are often misunderstood. The legal declaration, restructuring short-term bonds, extending maturities, imposing temporary payment suspensions, is only one part of the reset. The larger adjustment happens through currency repricing. It feels sudden. It isn't. The yield spiral signaled it. The reserve drain prepared it. The short-term maturity clock demanded it. Currency adjustment is not moral failure. It is pressure redistribution. Once reserves cannot defend the peg and refinancing costs exceed sustainable levels, the exchange rate becomes the shock absorber. It absorbs what bonds cannot. And here is the structural clarity. The government did not run out of money. It ran out of affordable refinancing. It ran out of reserves to defend stability at the previous exchange rate. It ran out of time between maturities. When time collapses, value adjusts. The reset restores equilibrium, but at a lower purchasing power base. Arithmetic, not drama. After devaluation, inflation surged. Banks faced stress. Output contracted before eventually stabilizing. The system didn't disappear. It recalibrated. Painfully, but mechanically. And once the currency moves, the cycle completes. Short-term debt, yield spiral, reserve drain, currency reset, sequence complete. Here is the uncomfortable recalibration. Governments do not default because they run out of money. They default because they run out of refinancing capacity. Shock. A sovereign that issues debt in its own currency can always create more of that currency. On paper, insolvency looks impossible. But liquidity and solvency are not the same constraint. If your debt matures in 10 years, you have time to adjust. If it matures in 90 days, you are dependent on continuous market renewal. The vulnerability is not the total debt stock. It is the maturity structure. Short maturity equals structural fragility. In Russia's case, the state did not wake up one morning with empty coffers. It faced a sequence of auctions where investors demanded yields that made rollover increasingly unsustainable. When that refinancing chain weakened, liquidity tightened before any legal default announcement appeared. Default was the label. Liquidity failure was the cause. This distinction matters because it reframes how crises form. They are rarely explosions. They are compressions. The time between funding needs becomes shorter than the time required to rebuild confidence. Time mismatch kills systems. And this is not unique to Russia. Mexico in 1994, Argentina in 2001, Greece in 2010. Different currencies, different politics, same maturity pressure, same pattern, same outcome. The default headline arrives last. The liquidity fracture arrives first. Not theory. Structural arithmetic. Every financial regime has a lifespan. The average lifespan of a fiat currency system before major structural change is often estimated around 27 to 35 years. Not because of conspiracy, because incentive drift accumulates over time. Debt structures evolve. Maturities shorten. Political constraints harden. The clock rarely announces itself. It compresses quietly. In Russia, in 1998, The critical clock was not ideological. It was maturity duration. When a large portion of sovereign debt matures within months, the government is effectively refinancing itself in real time. Each auction becomes a deadline. Each week becomes a checkpoint. When reserve coverage falls below short-term obligations, the clock speeds up. Investors calculate how many months of defense remain. Not rhetorically, mathematically. Coverage ratio declines. Exit probability rises. If short-term debt equals 100 and reserves equal 120, stability looks plausible. If reserves fall to 90 while maturities remain at 100, the imbalance becomes visible. Investors do not need panic to act. They need arithmetic. Compression accelerates. Now extend that logic more broadly. When interest costs consume an increasing share of government revenue, maturity shortening becomes tempting. It lowers immediate cost, but increases rollover frequency. That increases dependency on confidence renewal. Confidence must refresh faster than debt matures. If it doesn't, compression begins. No prediction required. This is not about a date on a calendar. It is about structure under pressure. When refinancing cycles shorten, the system becomes sensitive to small shocks. Oil price declines. Capital outflows. External rate hikes. Each event consumes time. And time, once compressed, is expensive to rebuild. The clock doesn't tick loudly. It tightens. And when it tightens enough, something adjusts. Historically, it's arithmetic. The purpose of an autopsy is not to relive the event. It is to recognize the structure. Russia in 1998 was not unique because it was Russia. It was structurally exposed because of maturity compression, yield acceleration, and reserve fragility. The flag changes. The arithmetic does not. Today, many sovereign balance sheets are larger than they were 2 decades ago. Debt to GDP ratios are higher across developed and emerging economies. Interest costs, after years of low rates, have begun consuming a greater share of government revenue in multiple jurisdictions. That alone is not crisis. It is pressure. Now, consider maturity profiles. When governments shorten duration to reduce borrowing costs, they increase rollover frequency. More auctions, more dependency, more exposure to rate repricing. Shorter maturity means more checkpoints. More checkpoints mean more sensitivity. Add to that global capital mobility. Funds move faster today than in 1998. Information spreads instantly. Liquidity evaporates more quickly in thin markets. None of this guarantees instability, but it compresses response time. Time compression increases fragility, and reserves, whether foreign exchange reserves in emerging markets or domestic central bank balance sheet flexibility in developed economies, remain finite in practical terms. They are large, but they are not infinite relative to short-term obligations. Coverage ratio always matters. The structural rhyme is simple. When refinancing cycles shorten and interest costs rise faster than revenue and reserve buffers thin relative to obligations, time begins to matter more than debt size. No country is permanently immune to arithmetic, not because of weakness, because of structure. Same incentives, same pressures, same math. The lesson of 1998 is not that collapse is inevitable. It is that liquidity stress precedes legal default, and maturity structure determines how quickly stress escalates. Systems rarely explode without warning. They compress first. Let's compress the entire sequence. Step 1. Short-term debt addiction. Maturities shorten. Rollover dependency grows. The clock accelerates. Step 2. The yields spiral. Investors demand higher compensation. Higher yields increase future borrowing needs. Debt feeds itself. Step 3. Reserve drain. Currency defense consumes buffers. Coverage ratios decline. Exit incentives rise. Step 4. Currency reset. When refinancing becomes unaffordable and reserves insufficient, the exchange rate absorbs the imbalance. No single step guarantees default. The sequence does. Each stage narrows optionality. Each stage reduces time. Each stage shifts pressure from one balance sheet to another. Bonds strain. Reserves strain. Currency adjusts. Sequence complete. No mystery. No conspiracy. No drama. Just arithmetic. A government does not need to run out of money to default. It only needs to run out of affordable refinancing. When debt matures faster than confidence renews, and when reserves fall faster than obligations, and when interest costs grow faster than revenue, the adjustment becomes mechanical. Legal default is paperwork. Liquidity failure is mathematics. In 1998, Russia did not wake up bankrupt. It woke up compressed, and when time compresses far enough, value adjusts. Not politically, not emotionally, arithmetically,